and welcome to Fundamentals. We are back after a break as the situation commands. With the Indian markets at an all time high and confused global macros, it is the need of the hour to get a view from a market expert. Our first guest as we restart this series is Mr. Gaurav Misra. He co heads equities at Mirae Asset Mutual Fund. He has over 26 years of experience and is an alumnus of IIM Lucknow and St. Stephen's College, Delhi. Thank you, sir, for joining in today, and we really appreciate your time. So, my first question is on the macros. When we look at India, we are undoubtedly better placed than many of the larger and leading economies like US and China. But we also understand with exports comprising 20% of our GDP, we cannot remain insulated from the rest of the world for too long. The term we often hear these days is decoupling. What are your views on the same?
Yeah, my views are that India, of course, is predominantly a domestic economy, whereas, of course, there are those export linkages which cannot be denied. Having said that, even for those export linkages, there's always scope to emerge from the low shares we have globally in trade of both goods and possibly even of services. So, for instance, in the recent few quarters, we have been seeing, despite the uncertainty on global growth, we've been seeing quite a strong revival in India's electronic exports, for instance. So this is really a bottom up that there is scope to carve out share in certain goods and services, which might have been neglected earlier, and where maybe courtesy, government thrust, PLI schemes, and all of that. From a low, in fact, from net importers, we have turned into exporters. Similarly, on the services side of exports, besides, of course, the well-known IT, but we are clearly seeing some pickup in other services as well, which come under maybe the category of the global captives across different industry verticals. So I'll say that the bigger thrust as far as India's growth is concerned is really the domestic economy, and there we have quite a few favorable cycles at play. So whether it's the real estate, whether it's the banking credit quality cycle, and even some sectors which were cyclically in a downturn till a year and a half back, like autos, etc. They're also on a recovery path, a decent recovery path. Whichever way we look at it, at least as far as the domestic picture is concerned, a stable to improving macro, reasonably decent consumption, both urban and I would say that rural getting slightly better, and a stable sort of capex outlook. I think that will provide the bulk of the thrust, to the India growth. Yes, there will be on the margin some impact depending on this slowdown. Of course, global growth so far in this year is actually surprised by its strength, and we really don't know, right, whether the slowdown will be very severe or whether the world will kind of carry along. So this year, in fact, at this stage, growth rates for global GDP have been revised upwards. We still have to see whether those rate hikes will bite, etc. But I would say that as managers and as investors, we're really looking beyond. There'll clearly be a phase in a matter of quarters when some of these tight monetary policies will be reversed. In which case, the sort of the hindrance to growth, which is being feared, will also reverse. So as long as the horizons are longer, 2 to 3 years short, all this will kind of balance out.
Right, sir. I totally agree with you. The numbers on services plus remittances almost stand at double of what they used to be, say even 5 years ago. Now, this brings me to the next question on valuations. Now, if you look back at how the Indian market valuations have been, they have remained largely range bound as far as 2022 and the first 3 months of 2023 have been concerned. But right now, as we speak, they're trading 12% over long-term averages. A large part of the rally that we have seen over the first quarter of FY23 has been led by, say, FI flows. Now, my question to you is, do you anticipate FI flows to remain, as robust as they have been in the last 3 months? I would also like to understand that, if FI flows is the way to be, which would give the market, the next leg of maybe, a small rally, should the larger incremental allocations be done in the large cap space?
Well, call on FI flows should not really, determine or influence our decision making, beyond a point. So you're right that, the flows have surprised in the recent months. Um, but very difficult to say, to what extent these might continue. Surely there could be a level at which, the valuations, as you're suggesting anyway, have moved slightly ahead of long period averages, could be a deterrence for further flows. In the meanwhile, it could be that some other, emerging markets or some other markets are clearly appearing more attractive on a relative basis, and then money, flows out. So I think this is going to be part and parcel, of the dynamics, when we are investing or allocating to equities. So yeah, I mean, we know that at the start of the year, China is where the money came in, it's exited, but maybe relatively now, at some stage, money goes back to some of those markets. Um, if it has, historically, also your observation or your implied suggestion is that money, when it comes in through the FI route, is uh, mostly diverted towards the large cap. This time around, we sense that there's a slightly greater share which has gone towards mid caps, actually, and we're clearly seeing strong rallies there. So again, I mean, going forward, as investors, I would think that wherever the value proposition is best is where money would come in. Large caps, of course, have that ease for FIs to be, to get a representation into the Indian market, and also whenever they want to exit. Um, but I will not be in a position to say that definitely I see, money coming in only in the large cap. It could well be spread out, and that really gets us to that earlier point that, if the India story is looking decent, notwithstanding valuation in the market, then I would think there'll be, a fairly broad-based growth across sectors. And as we know, some sectors are represented more in the large cap, and some actually more in the, the mid.
I would like to understand from the capex point of view. We can break the capex into three main constituents, which is public capex, household capex, and the corporate capex. While we have seen green shoots as far as the public and the household capex is concerned, we have not heard, large announcements as far as corporate capex is concerned. I would like to understand from you that what is the sense you get when you interact with the managements, given the fact that capacity utilization stand above 70% as we speak.
No, you're right. You're right. And actually, at a base case level, I'm not really building for any J curve sort of pickup in corporate capex. And you're right about, the capex underway through households, basically residential, and the government, of course, through the budgets. We see, how over the recent years, both central, and especially the center, and many states are also, are doing the job on that front. See, as far as corporate capex is concerned, I mean, why I think it's going to be more business as usual is really the composition of that capex. So if you have seen some very strong cycles historically, where you see strong jumps in growth in the capex spending, this time around, it'll be a bit more steadier growth, and the reason is really the composition of that capex. So historically, there was three, four sectors which were the big drivers of capex. As in, these were sectors which would, involve very big ticket projects, and when, that would be announced and executed, the numbers would, swing quite strongly on the upside. Whereas a lot of these sectors which currently, are doing capex, and where we speak to companies, it could be firms in the healthcare, specialty chemicals, automobiles, a host of consumer discretionaries. They're all, as you're doing the normal capex is, maybe there's an additional thrust because of PLI, but it's relative to their own gross blocks. These are reasonably strong, expansions they're undertaking. But when we look at it in aggregate, it does not move the needle, by a substantial amount. And again, that brings me to, those 3-4 sectors which have historically been big chunks of this capex. So, those 3-4 sectors included, metals. Then it included oil, gas, petchem, and it included, thermal power plants. Now, as we know, that thermal power plant is now, that story is a bit behind, where as a country, the focus is more towards renewables, where clearly it's not at all, the capex intensity is lower, it's import and all of that. So, that kind of pulls down the aggregate growth. as you might imagine, even in metals, there is a certain slow momentum. There were some announcements made, the peak of the metals rally a year and a half ago. But since then, we have to really see if, how it's going to unfold. But at this stage, uh, between oil, gas, petchem, and metals, it's not, a major, deviation in terms of a major ramp up in spending. So these two, and along with a very, very lackluster thermal power generation outlook, in a way is holding back the aggregate increase in capital spending, whereas the other sector which we touched on, they're business as usual.
Right. Now, coming to Mirae as a house, we have seen that you have significant exposure to all the new age tech companies, right? Now, while questions on profitability is something which only times will tell, but most investors, when we speak to, they often are more concerned about corporate governance issues, because they keep, stemming in different forms and fashion with different companies at different times. I would like to understand from you as to how do you do the checks as far as corporate governance is concerned before these companies become a part of your portfolios. And second, there is also a school of thought which says that promoters don't leave enough money on the table for the minority shareholders before they come to the primary market. So what would be your take on this?
Well, yeah, there are a couple of questions here. So first is on, aspect of corporate governance. Of course, that is something we would not, at all compromise. And if at all we come across this situation, we have made a mistake in assessing, our judgment, they will clearly, exit that. Of course, a lot of these companies which list or have listed, there's been involvement of other, investors, private equity investors, etc. We ourselves do a due diligence, with whatever financials are available in the public domain to check out other aspects within the corporate governance domain, related RPTs and all of that. The fact is that also some of these these new listings which have happened, they are often trying to carve out a space for themselves on a differentiated business model, really, right? I mean, the whole thing based on the platform, if I may, get. And in a way, regulations are not completely laid in stone for some of those categories. So there's always that element, and we have to acknowledge that sometimes the regulators are moving in tandem, ahead, sometimes behind, and so there is that element with some of these business models. But then we also hear from the managements and what are they saying, and what is their thrust, and you can make out that that if they're clearly saying we want to be on the right side of whatever the regulations are, and as they emerge, even if it means tweaking their business models as they go along. But yeah, in a sense, these are not they were not steady state industries. They're just emerging, carving a niche, maybe on the back of the increased digitization of the country, all of that. So that's one, of course. Then sorry, your second question was really on. If you may repeat that, please.
Yeah. So, sir, my second part of the question was that, there is a school of thought which believes that when promoters get these companies to the primary market, they don't leave enough for the minority shareholders. So how do you, kind of look at this?
No. I mean, this is it's a phenomena where I kind of partially agree with you that, typically if you see, the IPOs come at a certain stage of the market when things are really, heated up and stuff. And besides the promoters, it's also the investment bankers, etc., who are involved in the valuation suggestions, and they of course have sensed. They do some rough estimates of what the demand will be like, and that's how that whole price is determined in a way. Yeah, I mean, this is really there are industries, firms we have participated in the IPO time, where from where we entered, and we got a reasonable representation in our portfolios in those stocks. Maybe because market was not necessarily chasing them, but they're good businesses and they've gone on to do well. And there's some others where it could be approach where you take it step by step. You want to be exposed to the business to start with, and then see how they are executing, how the model is evolving. And if it looks like it's in the right direction, then you could look to increase exposure. So it's not as if you are taking full exposure, a full weight, an ideal weight in the at the IPO stage. That's in fact never the case in these. It's very, if you look at it as a percentage of the portfolio, that they definitely are within one at the entry level, within a percentage, sometimes even within half a percentage point, when they come into the portfolio. Then it's how the businesses shape up. So you're right that there is that at the IPO stage. Typically, the valuations should be leaving a bit more, for investors. That's something you have to grapple with. But there are also then opportunities which come. They don't one doesn't have to necessarily chase something, if it goes, on listing, etc. And sometimes opportunities come in the sense that there are corrections as well, and that's the time if you have comfort in the business, really. So whether it is new age or any business, it's really the strength of the business model. How are they further building on the moats in that, and if it's a network or a platform based, then how are they curating that, and kind of building upon that, and looking at and monetizing it, etc. Those things become important. Of course, all of that can be eventually translated into some value for the business, where we have to give some margin. Some not exact, some margin of assessment that yes, the current margins are here, but they will get there, given the cost structures and the growth dynamics. And then if it looks like it's there's some value gap, we have then added into some of these businesses at those price points. Yeah, I'll just say that. I'll just say also that typically at this level, for instance, whatever we've added, our average costs are below what the current market prices. But these things evolve. These have to be tracked.
Understood, sir. So now moving on from private market to public market, and my next question is about the mega merger which we have seen recently between HDFC Limited and HDFC Bank. If you go to your fact sheet released on 30th June, we see that you have a cumulative exposure of around 13.5% approximately in these two entities. Now you have to abide by the regulatory requirements going forward. So what do you see as an impact of this on the portfolio, and how are you going to realign it?
Yeah, the weights of the individual entities in the index, especially in the benchmark index for the large cap, whether you look at the Nifty 50 or the NSE 100, are over 12 to 14%, depending on which index you're looking at. So it was in that context actually, and just to put in perspective, we used to be underweight till mid of last year, and when there was a bout of correction, that's when we actually increased, our weights at that stage. So, there is a window, there's a time, which can be, which can be extended as well, with due permission. So within those time limits, basically we will be rather looking, to realign those weights. And really the way it is, as I was saying earlier, the banking and the whole non-bank cycle itself is also looking pretty good. We can hope for days where when the relative propositions are attractive, and make those switches. So it's not as if there's only one place, so to say. There are other places, and the cycle is good. So I don't see too much of it. Of course, there's no concern at all on liquidity and all that, notwithstanding the size and all of that. If you just see, it's a very small amount which has to be transacted in the overall scheme of liquidity for that name. So yeah, between at this stage, I would think it would be really within the financials itself that the weights would move. But if your concern was that, is there any liquidity or technical challenge? There is none of that really, and we have adequate time. We'll just be executing it on the days or month or week where we think the relative proposition is best.
Got it, sir. And we trust you for that. So my next question is about a sector which has not participated in this leg of rally, and that is a heavyweight in Indian equity market, and it's IT sector. When we look at your portfolio, you do have sizable position in Infosys and some position in HCL also. Now my question is twofold. One, what is your view on this sector? And second, how long do you think the effect of whatever is going on in US, be it in the banking sector or on the overall growth front, going to impact this sector?
We have a kind of full stance in that space, full weight stance. And I think there actually, besides the two names, there are two other names as well in the. See, I mean, there is one issue is, of course, the sentiment related, where, with reference to the US and the fear coming from that geography, the impact that will cause. But as I was saying earlier, that clearly this year first half growth has surprised both in the developed and emerging, but especially including the US markets. So people have really revised upwards the growth. It's true that we really don't know precisely, the impact of all this Fed tightening, and the lag effect it will have in the months ahead. It could be a bit worse than feared and so on. That's clearly a known unknown. Let me put it that way. But we're seeing results come out in the US, whether it's their own tech or their banking, etc. And there's a certain reasonable health. You might have also been seeing various investment houses, etc. When at the start of the year, everybody was talking about recession, but they're maybe not being so, so forceful about that now and backtracking a bit. But we really don't know how it's going to play out. I think, again, at a price and with a slightly medium-term view, I think the space will do well, and that really is the driving sort of rationale. There can be a volatility, but I thought there's the prices at which we built those really did cover for major downside volatility. It's conceivable that the weeks ahead at some stage there is down ticks as well. But that's the approach that at a certain price it was all the negative was in a way built in. I'm not saying I might have a slightly positive view actually on the way the US economy will probably but even if it were not to be, I think net will still come out all right with this space. And I'll just give two reasons, fundamentally. One is that, of course, the pre and post COVID, there is a fundamental leg up in the growth outlook because of this need to migrate towards cloud, by the whole corporate world in the US, and and they're just maybe 25-35% of the way through. So there's that journey. Yes, it's got taken a pause the last few quarters because of this uncertainty, and even there, I'm sensing that it's maybe that will also eventually give way. The clouds will clear, and second is, of course, Indian firms have proven their ability to be there, and even in the more new age, cutting edge like AI and all that, I think they will have the ability as well to participate. And these firms have, at least the larger ones, etc., have also much better financial discipline, in terms of their capital allocation, dividend distribution policies. That also gives a support to their valuations, etc. So it's just a matter of growth coming back, but which I think will be which will happen rather than not, and therefore that outlook towards the sector.
It's very encouraging to hear that, especially in Bangalore, where we have a lot of second order and third order effect from these companies. So we'll really look forward to these companies getting into the growth trajectory. My next question is specifically to your fund and its size. So you are managing 35,000 crore AUM, which is fairly sizable. Does this kind of a size become a challenge for you to take active share and generate alpha? If yes, how do you address that? And if no, at what size do you think it will become challenging for you to beat index meaningfully? And how would you address at that point of time?
Yeah, I mean, see, the way I think about this is that where we are as a size of the fund is not really a constraint in the large cap space, or at least within the large cap category. Simply because we are part, or we represent a system where there is a certain growth of 10, 12%, in terms of nominal, GDP, and corporates are going to participate, by a similar magnitude or not, if not slightly better, So when that sort of, growth at the system level is going to happen. So when you talk about India becoming from a current 3.5 trillion to, 5 and 7 trillion in the next, let's say, whatever, 5, 8 years, it's inconceivable that, the large caps don't participate in that, they're going to be doing that. There are many industries you can imagine, right? From consumers, staples, banks, etc., where, being big is actually an advantage, maybe in terms of so many attributes you can think of, right? You need a pan-India distribution, advertising economies, manufacturing economies, etc. So I think for an economy like for India, where we are, the relevance of large cap is going to be very much there in the years ahead. And as they grow, then automatically it's going to lead to higher profits, higher volumes, liquidity in the market, etc. So that's not a constraint. As long as we grow as a fund broadly, in line, plus minus a little bit. But if the AUM for any large, big large fund were to just all of a sudden have a major step jump, then maybe there could be challenges in building up positions beyond the first maybe 10, 15 names. That might be a challenge. But otherwise, when you're growing steadily, then to incrementally be deploying in wherever the value propositions emerge within the large cap, I don't think that should be a constraint.
Understood, sir. And so my next question is about the performance of the fund. Now, if we look at your fund over a longer period of time, it's been a very consistent fund, and it's been a part of our recommendation for the last 6 years now. But if we look at the last 1 to 3 years performance, which is a little near term, you have had patches where you are underperforming benchmark as well as the peer group. So what would you attribute this to?
No, I think versus the benchmark on a year to date or a 2-year basis, we would be ahead. But yes, in the relative scheme of things, there has been this patch. And if I were to point out maybe one reason, it's really that a year and a half ago, at the start of say last year itself, we were kind of reducing weights, keeping away from sectors which we thought were getting under the ESG stricture. So whether it was the fossil fuel related firms or dealing with that whole cohort, or even maybe cigarette companies, etc., where we were downsizing or not really going overweight and all that stuff, and that in a way worked against us in that period when that part of the market did very well, and it really helped to have been there. So I think that really would have been the primary factor. I think eventually all these things will normalize, and I think our approach both towards stock selection, where we do give preference to quality growth and picking them up at reasonable price, and building a fairly diversified portfolio where our active weights at the stock levels are much more than at the sector levels. Kind of approach that this combination of stock selection and portfolio construction should help to claw back. And we're seeing in the recent sometime that there is some pull up in.
So even we have been observing the recent improvement in the performance, and we are also very hopeful that the performance which you have displayed over a longer period of time would be reflecting in the portfolio very soon. So with this, we come to the end of our conversation, and it would not be prudent to end this conversation without understanding the risk to the market. Now, when we look around, we feel there's a lot of euphoria around in the market. Do you believe that this euphoria is a little bit overstretched, or you feel that we are still at the beginning of the rally and we have still a lot more to cover in this?
No, I mean, ideally, I would hope that the markets consolidate. If nothing, at least time correction, maybe some price correction, surely as well. But yeah, I mean, to an earlier question, it's clearly the flows from overseas which is causing this. One fine day they might figure out some other market and pause here, etc. So this could, correct. Yeah, you could call it some. So yeah, if you were to ask me which camp, I would be more in the very cautious camp at this stage. That's how I would put it. Of course, the comfort is the India stories in that. The macros have gotten only better, as the year has gone by, and the growth impetus across, overall system, and then young corporate earnings outlook is fairly broad based, and it's not getting cut either. Yes, there can be some pockets, maybe through overseas linkages, etc., which we have to negotiate. But that's always, there's always going to be some pockets which are not firing at full cylinders. So that's the sort of comfort that with a structural story for an investor, if you're putting in allocating with the 3-5 year horizon, even from where we are, you would have made on a CAGR basis better returns than other alternative asset classes. And of course, I'm not suggesting that you jump in at this level in terms of lump sums and all that. One is, got, say, a systematic plan which is underway. It's best to continue, notwithstanding this level we are at, because you never know, right? A week, a month down, you could be averaging through the SIPs at lower levels as well. So best to keep that allocation, that going. But yeah, also just keep your sort of asset allocation piece also in mind.
Understood, sir. So asset allocation, being cautious, and having a little medium-term view. I think these are the 3 things which will help an investor who's participating in the market even at these levels. So with this, we come to the end of our conversation, and we thank you enough for giving us a lot of perspective, not just with respect to India, but with respect to global macros as well. And I'm sure this conversation is going to help our investors also in terms of getting a broader understanding of the market, as well as Mirae Large Cap Fund and the philosophy of Mirae as a fund house in general. Thank you very much for sparing out time on a busy day and taking this call. Really appreciate it. Thank you, sir.
Yeah, thanks all. Have a good day.